The pros and cons of active versus passive investment strategies. Investing is the process of allocating capital to different financial assets, with the aim of generating a return on that capital. There are two primary investment strategies that investors use to achieve this goal: active and passive investing. Both strategies have their own advantages and disadvantages, and the decision of which one to use depends on an investor's financial goals, risk tolerance, and investment style. Active investing. Active investing is an investment strategy that involves constantly buying and selling securities in an effort to outperform the market. Active investors believe that they can identify undervalued stocks or sectors and can exploit market inefficiencies to generate higher returns than the market. Active investors typically spend a lot of time researching and analyzing stocks, and they often have a deep understanding of the companies they invest in. Pros of active investing. 1. Potentially higher returns. The primary advantage of active investing is the potential for higher returns. Active investors are constantly looking for undervalued stocks and sectors that they believe will outperform the market. If they are successful, they can generate higher returns than the market. 2. Control over investments. Active investors have complete control over their investments. They can choose which stocks to buy and sell, and they can make adjustments to their portfolio based on their analysis of the market. 3. Flexibility. Active investors can adjust their investment strategy to changing market conditions. For example, they can quickly shift their portfolio from growth stocks to value stocks if they believe that value stocks will outperform growth stocks. Cons of active investing. 1. Higher fees. Active investing typically involves higher fees than passive investing. Active investors pay fees to their financial advisors and brokerage firms, and they also pay higher transaction costs when they buy and sell securities. 2. Higher risk. Active investing is riskier than passive investing because it involves constantly buying and selling securities. Active investors may make poor investment decisions that result in significant losses. 3. Difficulty in consistently outperforming the market. Despite the potential for higher returns, active investors may find it difficult to consistently outperform the market. Studies have shown that active managers have a hard time beating the market over the long term. Passive investing. Passive investing is an investment strategy that involves investing in a diversified portfolio of securities that closely tracks a benchmark index, such as the S&P 500. Passive investors believe that the market is efficient and that it is difficult to consistently beat the market. Instead of trying to beat the market, passive investors aim to match the market's performance. Pros of passive investing. 1. Lower fees. Passive investing typically involves lower fees than active investing. Passive investors pay fees to their financial advisors and brokerage firms, but they typically pay lower transaction costs because they do not trade securities as frequently as active investors. 2. Lower risk. Passive investing is less risky than active investing because it involves less trading. Passive investors do not try to outsmart the market, and they do not make frequent changes to their portfolio. 3. Consistent returns. Passive investors can expect to earn returns that closely match the performance of the benchmark index they are tracking. Although they may not earn higher returns than the market, they are also less likely to earn lower returns. Cons of passive investing. 1. Limited control over investments. Passive investors do not have as much control over their investments as active investors. They are limited to investing in securities that are part of the benchmark index they are tracking. 2. Lower returns. Passive investors are unlikely to earn returns that are higher than the market. While they may earn consistent returns, they are also less likely to earn above-average returns. 3. Vulnerable to market downturns. Passive investors are vulnerable to market downturns because they are invested in the market. If the market experiences a significant downturn, passive investors may experience significant loss.